one of the things that usually happens during capitulation is that interest rates stop going up and they start going down sharply. So we've had kind of the beginning of that. So when last time we talked about this monthly resistance on the lower panel there, it's kind of at this level here. We kind of got a little bit above that, but really came back off of it. We've started coming down. Generally, when the market goes down and it's setting up for a bottom, you should have bond prices up pretty sharply. Didn't have that today. So I think we still have a period of capitulation potentially in order for the market where we see prices going up and interest rates coming down more sharp. That sort of reflects this situation where all of a sudden investors and even the Fed are starting to say, okay, is the market falling sharply enough that I'm now concerned about recession or serious economic slowdown? And that change in view is one of the things that usually puts a capitulation low in the market. We're not there yet. But treasury yields are already starting to imply a recession. So it could be that we get a capitulation low pretty quickly, and if bonds really take off, that'll be one of the signals that we're getting to that point. The problem really is that we already had inflation spiking to the highest level in 40 years. And then for some reason that I cannot fathom, the West decided to push their hand and box Russia into a corner to the point that it felt like it had no choice but to take back Ukraine so that it doesn't turn NATO. I'm not sure what the benefit of that is, but I can tell you it was the worst possible time. It was a time when now inflation is really going to go nuts. Maybe they want to blame inflation on Russia. I don't know. I don't have any idea what could possibly be worth this, but that's where we are. And the thing to realize is from this lower panel, we were already, so there's market rates and there's the Fed funds. That is the biggest gap, the most behind the Fed has been behind market rates since the 1970s. And it's going to let inflation go much further already than it should have, and than it will, going forward, particularly if we get further shortages, which are already starting to get. The real question now is going to become whether we have global recession out of this. You can see that the GDP now has already started drifting into negative. And that's for the US, right? The US doesn't really have this problem that Europe has, that where it gets like 50% of its coal and energy from Russia. And so if they cut that off, instant recession. We don't have that problem quite, but there are follow-on effects and things that this is just going to be a mess. So we have to watch out for potential recession. The good news on the COVID front is that we continue to look like the South African profile pretty much everywhere. And it's a very sharp decline. It's a sharp decline, and it had more people getting it, and it was a mild version, didn't overtax the healthcare system. And so now all those people have the only real vaccine, which is natural resistance and overcoming virus. So it's good possibility that, yeah, we'll probably have some further variants, but they won't be nearly as deeply felt as this one, because so many people got Omicron that now they have resistance to further variants. So that's a hope that is getting more and more real. And we'll see how it irons out, but there's a good chance that we're going to have some reacceleration from real reopening after this comes off the boil a little more globally. You can see that now it's realized that much of the rest of the world is making new corrective lows. Okay, the US is one of the few markets that's not, but it's not that far away anymore. We're just about 4,200 now today at the close. So we're in a substantial retest. We're in this intermediate term correction that is in a downtrend channel. Haven't had the lot, you look at RSI, you always try to get RSI to break over 60 to say that you're in a new trend. And then look at that bottom panel, which is the advanced decline line. It is making new lows Friday and today again, which generally means new lows in the indexes ahead. Now, we did have divergence at the lows in the NYHL, that top panel, and so that'll hold over if we make any new lows. But I think we're probably going to have to severe retest or make new lows to make any kind of a capitulation bottom. We never really got a full capitulation bottom on that first correction. And so we got this bear market bounce type situation. And now we're heading back into a retest. And there could be further rounds. Just depends on a lot of things now because the macro situation is really precarious. All right, and these are good things to watch for the near-term prospects. These are downtrend channels on the hourly chart, and those, you're going to need to break above both in the S&P and in the NASDAQ for really any kind of even short-term rally. And whether that's a short-term rally or it's an intermediate-term bottom depends on whether we correction over and how the internals respond. So far, we don't have signals that's done yet. You can see the small caps. Small caps now have had a bounce in relative strength that Dominic was just highlighting with his cursor. But the downtrend channel in the relative strength still obtains. And until that's really broken on both the mid caps and the small caps, we have problems with breadth. But small caps are trying to outperform here, but they're still basically coming up, hitting prior lows and coming off them. So they're giving some hopes and some, little green shoots, but nothing more than that. And they're not able to follow through when the bulk of the market is really against them. Okay. And, we did this in PSL, but basically the real thing, I think the bottom line is we've got demand, the orange index, it's kind of been in a trading range. We've got supply, the blue index, it's still trending higher and close to new highs. And what that does is the spread, which is the gray index, the bottom, that's the difference. That's the net spread. And you can see that the net spread is still far below its downtrend line, far below its 200 DMA, below its 40 DMA, and below its December lows. All those are negatives. You really want to see from an intermediate term standpoint, at least see the spread breaking above its 200 DMA and its downtrend to think that the environment has really shifted. Okay. All right. And then the major internals, always look at the major internals. That a lot of those are partial components of those other indexes. But the thing that I want people to kind of get in their head is that take a look at the advanced decline line in the top panel. We've just broken down from like a 9-month head and shoulder topping pattern and are now trending lower. That actually is very rare to happen in anything other than a bear market. So for this to happen in a major correction, it's a real concern. It's not just the advanced decline line. Take a look at the line under that, which is the NICE cumulative net volume. It's had an 11-month head and shoulder topping pattern that it's broken down from. Take a look at our net points index at XVG. That's had a 7-month head and shoulder topping pattern that it's broken down from. And take a look at the bottom panel, which is the OCO, the operating companies only NICE advanced decline line. That's broken down from about a 9-month head and shoulder topping formation. Those are actually big breadth type action that you would see at the beginning of a bear market. And so it's a real concern unless we break back into all those ranges and kind of break above the midpoint of the ranges. This really has big risk written on it still to the downside. Okay, sentiment is starting to get overdone, and that's a good thing. Often that happens weeks or even months before a bottom, but the fact that it's starting to happen does say, okay, maybe if we get a capitulation low now, it's cleaned out enough that we can actually get a decent rally. I think the other thing on that just to realize is that absent anything else, you really have to close over that 4,600 level in the S&P to really say, okay, the trend is not down anymore on an intermediate term basis. Right, which is right there, exactly. All right, now, so I've maybe scroll down just a little teeny bit more down right there. So what I want you to see is this is Germany. This is the German ETF. This is one of the largest capitalization markets in the world. Okay, it's crashing and making new lows. Okay, here are weekly some of the bad stocks in the German market last week. They're down 15 to 23% in a week. Okay, that's a really negative environment. Realize that the rest of the world is clearly making new corrective lows, and that often pulls even the stronger markets down, and that we really have to get this problem in Europe has to come to an end, or we're gonna all be cascading into a disastrous situation economically. Europe gets over 49% of its coal imports from Russia and over 45% of its natural gas imports. And Russia and Ukraine make up a huge percentage of wheat production. Right now, the US, the largest wheat producer, has drought conditions in the wheat growing areas. So we could see food prices absolutely going insane. And just to give you an idea, oil prices are up 25 to 30% since Russia invaded Ukraine, and wheat prices are up more than that. And that's before all the inflation numbers that we're looking at that are record levels. So this is kind of the worst time possible to instigate a crisis that creates more inflationary pressure, but that seems to be what policymakers are doing. One of Chuck's favorite, again, is to watch the high yield. The high yield has kind of been going hand in hand with the market, leading on the downside. I just wanted you to see we've made new lows in the high yield market before the S&P, and so that likely projects new lows ahead for the main market. Okay. All right, now this is kind of like the 70s. This is if you go back and you look historically at what things would have looked like in the 70s, this is kind of it. For our top ETFs, we have more than half of this table is commodities. And realize it's not the commodity stocks, it's the commodities themselves. Commodity stocks are underperforming. Energy stocks are way underperforming oils, right? Base metals are way outperforming the metal stocks, even though some of those metal stocks are some of the strongest stocks, okay? Watch for breakouts in palladium. Palladium looks like it could break out from a range to new all-time highs. Who's the largest producer of palladium in the world? Russia. Defense stocks are on the verge of a breakout. Material stocks are on the verge of a breakdown. Inflation stocks and high dividends. So those are things to watch. I probably would, you can nibble on the commodity breakouts and really be cautious about the stock breakouts, because about 60% of the time that you have a capitulation low on an intermediate term basis, what happens in that final phase is that all of a sudden the market is falling sharply to new lows so much that people start saying, holy cow, maybe this is recession. And so even some of these holdout stocks often play catch up at the end. Doesn't happen always, but it happens enough that you still want to be careful, even buying the things that are still holding up well, because at the end of a correction, they can play catch up. Okay. So our strong plurality groups right now, fertilizers, ag chemical, energies, miners, metal producers, oil and gas, E&P, defense, steel, shipping. Those are things that should be on your watch list. You could maybe lightly nibble, but I would go with the commodities or the commodity ETFs over the stocks. And even with the commodity ETFs, realize it's possible at those capitulation lows, they could fall very sharply. So you want to be careful about the degree of your allocation. Okay, and so our leadership remains mixed and has been poor for a long time. Potential bases, those are things to put alerts on if they break out. And we have a number of things that are post breakouts. Those are things that have already broken out, like in metals, in fertilizers, in E&P, in shipping, and steel. What else we got? That's pretty much it. Okay, so those are the stocks that are still running. And so if we get a positive environment, particularly for short-term traders, those are things to look at, and how well they do and whether they're able to pull more of the others up is going to be important to hit.